Hey value investors, how are you doing? My name is Stijn and welcome to my YouTube channel. Today we're talking about my top 3 hyper growth stocks to buy now. By the way, I would really appreciate if you guys let me know down below if you like this new video format I'm trying out. And if you like this new camera angle as well. Anyways, we'll be going in depth into each company specifically, their business plan as well as their competitive advantages. I will also try to lay out the value proposition I see in each company and we'll go in depth into my price calculations. So let's go. So the first company we are talking about is Regeneron Pharmaceuticals, which is a pharmaceutical company. Currently they have about 8 medicines, which you can see displayed on the screen right now. First, Dupixent, Evkeeza, Eylea, which as you will see shortly is their biggest medicine, Inmazeb, Kevzara, Libtayo and Praluent. And if we scroll down a little bit, we can see their emergency use only REGN, which is a COVID medicine. So not a COVID vaccine, but a COVID medicine if you do happen to get sick. So from this chart from the annual report, we can see that Eylea is their biggest revenue stream at about $8 billion revenue for 2020. Dupixent hits in at about $4 billion of revenue, and the other medicines do generate a significant amount of revenue, but it's just a tiny amount compared to how much Eylea manages to produce for this company. And we can also see about $200 million in revenue from REGN, which will probably decrease as time goes on. And aside from their current 8 medicines, they have 37 medicines currently in FDA approval or trials. So the FDA trials range from trial stage 1 to stage 3, and the further along the progress a medicine is, the more likely it will hit the markets. So they have 37 medicines in total, with about 8 medicines in phase 3 trials, so those are most likely to hit the market anytime soon. It is great to see that Regeneron is diversifying their product lineup that insane. I do encourage you to dig into their financials on your own, because I think that's a really important part of investing. Anyways, we're looking at Regeneron Pharmaceutical EPS, earnings per share, ranging from 2006 to 2021. And this is a really important metric to look at a company, since this shows their ability to earn profits. Earnings is basically profits at the end of the bottom line. And this chart, the top chart, shows the trailing 12 months EPS of Regeneron. So this is basically their profits. And we can see a really large increase from about $3 in 2014 per share to a whopping $35 in 2020 as a trailing 12-month EPS, which is just an insane return. That's about a 40% compounded growth in their earnings per share, which is the wet dream of any value investor. Let's go to the value proposition now. So this is the price calculations I did for Regeneron, or ticker symbol REGN. And as we've just talked about, they were able to grow their earnings per share at 40% compounded for 7 years already. We'll assume they'll continue to grow at 20%, which is in my opinion conservative, because they are actually accelerating their profits. Anyways, 20% for the next 10 years, that's these 2 columns, and also a future P ratio of 25, which is, according to my opinions, kind of conservative for such a company, especially since they've been able to hit this mark many times already. Also a 15% discount rate, which is my minimum return on investment. You can change that number however you like, but I use 15% for every single company. Anyways, we plop in their current 2020 EPS, which was $30.52, and then grow it 20% compounded per year. So until 2030, which is 10 years from now. And that would get them to a EPS of $190 per share in 2030. As we've said earlier, a future PE of 25, so $190 times 25 results in a future stock price of $4,700. That's just an insane number in and of itself, and that's almost a 10x increase from today's price as a blue chip company. And now we need to express that number as a fair share price today. So we discount that number at 15% a year. Again, my minimum return on investment, your number might change. But if we were to do that for 10 years consecutively, we would get to a fair share price today of $1,170-ish. But you gotta see this number as the price you see on a second-hand car at a second-hand car shop. So that's the sticker price, but you always negotiate this price. And we value investors always want this price lowered. So my own margin of safety is 50%, and I use this on every company. Sometimes I go for 40%, for example, if it's such a stable company as Apple, but most of the times I go for 50%. And that margin of safety results in a buy target of about $580. So to summarize the value proposition, we're assuming 20% growth, which is really conservative, a future P ratio of 25, which is again, in my opinion, conservative, and a discount ratio of 50%, which is really high, so again, conservative. And all these numbers, including a margin of safety of 50%, result in a buy target of $580. So at the current share price of $500 per share, this company is an absolute steal. Again, in my opinion, if you lose money, that's your own problem. I'm no financial advisor. I just want to add real quick that if you want to go more in depth into each of these companies specifically, I've linked a video on a deep analysis on each company in the description, so check it out if you're curious. Anyways, that leads me to the next company, Nouveau Monde Graphite. So this is a junior mining company that focuses on the exploration of graphite. And if any of you have seen this video I did on anode materials, you know graphite is a hot commodity right now. See, we're using way more lithium-ion batteries than we've used in the past. We're using them for smartphones, laptops, and especially electric vehicles. So demand for lithium-ion batteries is gonna skyrocket in the upcoming years. And the supply for those materials are probably unable to catch up. And from all the materials that go in a battery, graphite to me seems like the most interesting investment. Nouveau Monde has actually recently uplisted to the New York Stock Exchange, which is just the biggest news, and they are also planning to become a green carbon neutral mine, meaning they will use green hydropower from Hydro-Quebec, they'll get at low predetermined tariffs, electric vehicles, electric equipment, the whole shebang. I just love when a company goes the green route. This normally helps with the perception of the public, but also normally it lowers costs for the company, therefore increases their own margins. And from Nouveau Monde's own investor presentation, we can see that they are planning to do 45,000 tons per annum of anode material in combination with 100,000 tons of high purity flake graphite. So, as from their investor presentation, 100,000 tons of flake graphite at a price of $1,500 per ton, which is fairly conservative and actually the same number they used for their own calculations. But 100,000 tons times $1,500 per ton results in a total revenue for the flake graphite of $150 million per year. And anode materials, they've said they will produce 45,000 tons, which go for about $10,000 per ton. You can actually check the prices for flake graphite and anode materials online if you want to, but you'll see that these numbers are quite conservative. So 45,000 tons at $10,000 per ton results in $450 million in revenue. So if we were to combine these two revenue streams, so the flake graphite and the anode materials, that will result in a total revenue of $600 million from 2023 and onwards. Now let's try to calculate what would be fair to pay for Nouveau Monde. So we're assuming $600 million in revenue from 2023 and onwards, and it's currently 2021. We assume a 3% share dilution because they need to raise capital for this mine. Also a future price to sales ratio of 5 with a discount rate of 15%. But $600 million in revenue times a price to sales ratio of 5 results in a future market cap of $3 billion. Currently, Nouveau Monde has about 37 million shares outstanding, so with 3% dilution for each year, they would get to about 40 million shares in 2023. $3 billion divided by 40 million results in a future stock price of about $76 per share. So that's about a 5x return in just 3 years, which is an insane value proposition. And if we were to express that number in a fair share price today, so the sticker price of a second-hand car, that would result in $57 per share-ish. But we value investors don't pay fair prices. We want a margin of safety. And since this company is quite risky, we want a large margin of safety, of 75% actually. And that number results in a buy target of about $15 per share. So the current share price, about $15 per share, seems like a great deal, especially with such a large margin of safety. And this is what ensures the attendees in the future. And the third company we are talking about is Gratomic. Gratomic is a vein graphite mining company, so also a graphite mining company, but a vein. They are currently commissioning their plant to become fully operational at the latter half of this year. Their mine is located in Alchem, which is in Namibia, and Gratomic also intends to fully power its Alchem processing facility through solar power by 2022. So they're also trying to become a fully green, carbon neutral mine. Although they haven't stated that they will become fully carbon neutral in the future, I suspect they will do so. I do want to stress the fact that Gratomic is a vein graphite mine. See, there's a couple of different kinds of graphite, and that's not really important for this video, but Nouveau Monde is a flake graphite producer, and we know their margins, which are about $500 per ton. But Gratomic is a vein graphite producer, meaning that graphite is more pure and located closer to the surface. Both of these factors combined, so a higher purity and an easier extraction process, enables me to believe that Gratomic will have really low margins. Like I said, Nouveau Monde has about $500 per ton as a margin, and I think Gratomic will do about $250 per ton as margins. I also want to stress the fact that Gratomic is currently commissioning their plant and is trying to become fully operational before the end of this year. And I also want to stress that they have not completed the traditional studies of a junior mining company. See, a junior mining company normally first does a preliminary economic assessment, then second a pre-feasibility study, and then third a feasibility study. Gratomic decided to omit this normal process. I think this is because they are really confident in their resource since it's located so close to the surface and they know that they can extract it extremely easily. But it is good to know that this company is more risky because they haven't de-risked themselves by doing the traditional studies. Anyways, these are the numbers for Gratomic. Gratomic plans to do 100,000 tons of vein graphite, which goes for about $2,500 per ton, which will result in a revenue of $250 million from this source. They also plan to do 20,000 tons of anode material, which go for about $10,000 per ton, so this will result in $200 million in revenue from this source. Those two sources combined, so the vein graphite and the anode material, result in $450 million in total revenue from about 2023 and onwards. So that's where this number comes from. And because they haven't publicly done their due diligence, I will say they'll become fully operational at the year 2025. This is extremely conservative. So this is the current year, 2021, a share dilution of 1% per year, which is also conservative because Gratomic has said that they will not plan to do any dilution. A future price sales ratio of 5, which is the same as Nouveau Monde, and a discount ratio of 15%, which are used for all stocks. And these numbers get to a future market cap of about $2.2 billion. And based on their current shares outstanding with dilution, that means that the future stock price could be around $14 per share. So that's more than a 10x increase in about 5 years. And if we were to express that number discounted at 15% per year at a fair value today, that would be about $8 per share. Now we slap on a really high margin of safety, and that is because they haven't publicly de-risked themselves. So a margin of safety of 85% results in a buy target of $1.20 per share, which is still higher than the current share price. So Gratomic, like each company I've shown before, seems like a great buy at the current share price. Anyways, let me know if you like this format. This is way less scripted than I normally do, and I hope it comes across as more genuine. I really hope you guys enjoyed this video, and if you did, please give it a like and maybe even subscribe. Comment down below what you want me to talk about next, and I'll see you guys in the next one. Peace.